As the second quarter of 2026 begins, corporate treasurers are attempting to reconcile two entirely disconnected realities. In the physical global economy, a severe kinetic energy shock has brought critical maritime supply chains to a standstill. The ongoing military conflict between the United States, Israel, and Iran, designated Operation Epic Fury, has paralyzed the Strait of Hormuz. A vital artery for global energy transit is now functionally severed. Yet, inside the digital capital markets of the United States, there is historical complacency. Equity valuations remain rich, and the VIX, the market's primary gauge for implied volatility and fear, is resting near cyclical lows. Institutional capital is operating on a highly specific assumption. Algorithms are betting that the secular growth of artificial intelligence, combined with an $87 billion injection of bank liquidity from recent regulatory rollbacks, provides an impenetrable economic moat against overseas conflict. The math does not reconcile. The broader market is currently pricing in aggressive earnings per share growth of 14% to 16% for the year, while ignoring the reality of crude oil sustaining above $100 a barrel, and a logistics network currently bypassing the Persian Gulf at immense cost. For heavily concentrated portfolios, this disconnect guarantees severe structural margin compression. Input costs are surging at the exact moment consumer demand faces a massive inflationary headwind. Institutional allocators are severely mispricing the macroeconomic data, the attrition rate of the war, and the emerging systemic cyber-kinetic risks aimed directly at Western corporate infrastructure. Safely navigating the second quarter requires discarding legacy macroeconomic assumptions. Surviving this volatility depends on accurately reading the physical attrition and exploiting the temporal arbitrage created by the new 24/7 tokenized financial infrastructure. To accurately price the market risk, we have to quantify the physical attrition of the conflict. In the opening weeks of Operation Epic Fury, the United States military expended over 850 Tomahawk cruise missiles to target infrastructure across the Iranian plateau. This bar chart compares the massive scale of that single-month kinetic expenditure against the constraints of the U.S. industrial base. The military fired over 850 precision munitions, but the Navy is only scheduled to receive 110 replacement Tomahawks for the entirety of fiscal year 2026. This severe depletion rate creates an acute strategic vulnerability. It limits broader U.S. power projection in the Indo-Pacific and forces the current military campaign into a protracted tactical stalemate, removing the possibility of a rapid, clean resolution. Recognizing this timeline, Iran has deployed its own asymmetric leverage, maintaining a highly effective maritime blockade of the Strait of Hormuz. By choking off this specific geographic choke point, the blockade effectively removes 15% to 20% of global oil supplies and 15% of the world's liquefied natural gas from the open market. The diplomatic incentives are now structurally misaligned. The U.S. administration requires a rapid de-escalation ahead of the November midterm elections to lower domestic fuel prices, while Tehran is utilizing the blockade to demand extensive financial reparations and formal guarantees. A formalized near-term peace treaty is highly improbable. High-leverage asymmetric attrition and the elevated energy prices that come with it are now cemented into the global economy for the foreseeable future. The empirical test of whether the domestic U.S. economy can absorb this exogenous energy shock lies in the high-frequency economic data released on April 1st. This line graph tracks the ISM Manufacturing Prices Paid Index, the definitive gauge for pipeline inflation. The data reveals a sharp, violent spike upward, reaching a consensus forecast level of 73.8. A reading of 73.8 indicates a fierce resurgence of input cost inflation. Surging raw material prices and rerouted maritime logistics are causing severe corporate margin compression across the industrial sector. This pipeline inflation is colliding directly with a rapidly cooling labor market. ADP payroll data shows private sector hiring decelerating sharply, adding only 41,000 jobs as companies abandon expansive hiring for internal headcount management. Even the advanced U.S. retail sales data requires deconstruction. A nominal headline growth rate of 0.5% appears resilient on paper, but because retail sales are not adjusted for inflation, that dollar increase masks a severe drop in actual physical purchase volumes. As domestic gasoline prices surge past the critical $4 per gallon threshold, the cost of basic transit acts as a massive, regressive tax. It aggressively crowds out discretionary spending for the middle and lower income quartiles. This toxic combination of sticky inflation and deep consumer fatigue breaks the underlying math of the equity markets. The optimistic 16% earnings growth targets required to justify current valuations are no longer viable. Corporations outside of the cash-rich technology sector simply cannot pass these elevated logistical costs onto a tapped-out consumer base.
The heavily anticipated M&A supercycle is neutralized, leaving a deeply K-shaped stagflationary trap in its place. Beyond the macroeconomic data, institutional capital is entirely blind to a formalized escalation in the theater of war. The Islamic Revolutionary Guard Corps has officially pivoted from state-on-state military engagement to the hybrid cyber-kinetic targeting of civilian enterprises. The specific threat matrix explicitly designates 18 major U.S. corporations, including Microsoft, Google, Apple, and JPMorgan Chase, as legitimate military targets for immediate reprisal. The strategic justification for this targeting is rooted in modern warfare architecture. The Iranian military apparatus alleges these specific firms are actively complicit in the U.S. strike campaign through the deployment of AI algorithms, targeting analytics, and cloud computing support. Despite explicit public threats to physically destroy regional corporate infrastructure in the Middle East, the broader financial market has exhibited zero reaction. Implied volatility remains practically non-existent. This dual-axis chart compares the steady upward trend of the S&P 500 against the VIX, which is flatlining near a cyclical low of 14. Algorithmic trading models are treating the secular growth of artificial intelligence as an impenetrable moat, assuming any physical destruction of regional data centers will be immaterial to global revenues. Because fear is priced at cyclical lows, the market has created a massive asymmetric vulnerability for itself. A minor, highly localized kinetic strike on a Western corporate data center in the UAE would force an instantaneous repricing of risk, triggering a violent systemic market correction. Tech-heavy institutional portfolios are carrying peak valuations while operating completely blind to the frontline reality that their underlying corporate infrastructure is now an active military target. While physical shipping routes remain vulnerable to geographic choke points, institutional capital is moving into infrastructure that is inherently borderless, 24/7 natively tokenized financial systems. This digital layer allows for the continuous movement of value, even when physical regional hubs face kinetic disruption. The digitization of traditional capital markets is scaling rapidly. Real-world asset tokenization is currently expanding toward a projected $24.4 trillion total addressable market over the next decade. This split timeline compares the frozen state of a legacy U.S. equity market operating on a delayed T+1 settlement cycle over a weekend against the fluid, constantly updating tokenized economy running on instantaneous T+0 atomic settlement. This architectural gap in market plumbing creates a temporal asymmetry. Quantitative funds are specifically exploiting this gap to execute highly lucrative delta-neutral spot futures arbitrage. The mechanism is precise. When severe geopolitical news breaks on a Saturday, quants immediately short the decentralized perpetual contracts while simultaneously purchasing the natively tokenized spot asset on-chain to lock in the spread. This strategy allows capital allocators to capture tax-free yield continuously, entirely isolated from the arbitrary closing hours and frozen order books of traditional stock exchanges. Navigating this digital market plumbing determines whether a fund captures alpha or simply absorbs the impact of the next kinetic weekend shock. For traditional portfolios, the artificially low VIX dictates a strict defensive posture. Investors must build a rigid barbell asset allocation to survive the coming quarter. On the risk-on side of the barbell, allocators should maintain exposure to high-margin AI equities. However, they must aggressively purchase highly inexpensive out-of-the-money put options on the Nasdaq 100 to explicitly hedge against sudden infrastructure strikes. On the defensive side of the barbell, capital must retreat to short-duration U.S. Treasuries and physical precious metals. These remain the ultimate haven assets against systemic instability and structural inflation. This convergence of physical risk and digital assets also forces a critical internal mandate for corporate treasurers. As CFOs integrate tokenized assets into their balance sheets, the operational protocols must completely change.
Treasury integration of tokenized assets transforms cybersecurity into a systemic mandate for market stability, moving it far beyond the traditional scope of an IT department. If the administrative keys governing a tokenized cap table are compromised by a state-sponsored actor, the attackers can bypass all legacy regulatory controls and unilaterally mint counterfeit equity, destroying the firm's valuation instantly. CFOs must mandate hardware-backed key custody, enforce strict signer isolation, and implement algorithmic velocity controls on all corporate withdrawals. The regulatory deal winter of the early 2020s has officially thawed, but the capital unlocked by that relief must now navigate a hostile global environment where energy security, supply chain sovereignty, and cryptographic readiness dictate ultimate valuation.